With proven oil reserves of 171 billion barrels, the world's third largest, Canada's oil industry should be looking towards a rosy future. Instead, oil producers there face opposition from environmental activists to their plans to raise production and build new pipelines, along with the withdrawal of oil majors. It's fair to say that the future is looking a lot less appealing, and nowhere is this more so than the oil sands belt in Alberta. The Canadian petroleum industry arose in parallel with that of the United States, yet because of Canada's unique geography, geology, resources and patterns of settlement, it developed in a very different way. The first oil well in Canada was dug by hand rather than drilled in 1858 by James Milner Williams near his asphalt plant in Oil Springs, Ontario. At a depth of 20 metres or 66 feet, he struck oil, 1 year before the so-called Colonel Edwin Drake drilled the first oil well in the United States. Petroleum production in Ontario expanded rapidly from then, and practically every significant producer became their own refiner. In 1864, 20 refineries were operating at Oil Springs and 7 in Petrolera, Ontario. However, Ontario's status as an important oil producer did not last long. By 1880, Canada was a net importer of oil from the United States. Unlike the United States, which has several major different oil-producing regions, the vast majority of Canada's petroleum resources are concentrated in the enormous West Canadian Sedimentary Basin, one of the largest petroleum-containing formations in the world. In total, it underlies 1.4 million square kilometres, or just over 500,000 square miles of western Canada, and consists of a massive wedge of sedimentary rock up to 6 kilometres thick, extending from the Rocky Mountains in the west to the Canada Shield in the east. Because of its geographic location, the area was settled relatively late in the history of Canada, and its true resource potential was not discovered until World War II. As a result, Canada built its major manufacturing centres near its historic hydroelectric power sources in Ontario and Quebec, rather than its petroleum resources in Alberta or Saskatchewan. Not knowing about its own potential, Canada began to import the vast majority of its oil from other countries as it developed in the mid to late 20th century. Over the past few decades, a number of key acquisitions took place in Canada's oil sands that helped it to grow into the resource it is today. The first phase was from 2006 to 2010, when oil companies were acquiring underdeveloped assets to secure a position in developing Canada's oil sands. In the latter half of 2010-2012, Canada's oil sands saw the second phase of acquisitions dominated by Asian companies. These Asian companies, often state-owned, were acquiring existing sites for a premium in order to secure access to Canada's oil sands. As a sharp rebound in oil prices followed the financial collapse of 2008-2009, more oil sands projects were taken from development to production. Asian energy powers had been late to the game and therefore began buying up producing oil sands assets to secure future energy resources. The third and current phase of oil sands development has one thing in common: change. The oil majors are now leaving Canada. Total, Royal Dutch Shell, Statoil and ConocoPhillips have all reduced their exposure to oil sand assets in the last couple of years. Many of these companies are managing assets on a global scale. This means that they are forced to sell marginal fields in order to invest in more profitable ventures or refocus their capital towards core long-term operations. For the Canadian oil companies acquiring oil sands assets as the majors look to diversify their portfolios, the oil sands are their only core long-term business, and they must find a way to manage these assets to remain profitable or cost-effective. Aside from the overall structural change, the remaining oil firms are also retrenching, with large producers planning little or no further expansion and some smaller projects struggling to even cover their operating costs. As the era of large new projects ends, many mid-sized producers, those with fewer assets and producing less than 10,000 to 100,000 barrels of oil per day, have shelved expansion plans. Larger Canadian producers, meanwhile, focus on projects that in the past were associated with smaller names. Therefore, in the last 3 years, we've seen dozens of new projects being mothballed and expansions put on hold, meaning that millions of barrels of crude from the world's third largest reserves may never be extracted. In total, it has been estimated that more than $23 billion in Canadian assets has been closed in recent years, as production has turned to the US shale patches, which produce returns more quickly and where proximity to refiners means the barrels fetch a far better price. Where industry groups in 2014 expected Canada's oil sands output to more than double to nearly 5 million barrels per day by 2030, the forecast most recently released shows it being knocked down to 3.7 million barrels per day. Canada's oil sands are difficult and expensive to exploit. Not only does it take large amounts of energy from the steam required to extract the bitumen, but once extracted it also requires mixing with large amounts of lighter hydrocarbons to transport in the pipeline. Unsurprisingly, therefore, the whole process has attracted the ire of many environmentalists, and some oil companies involved in the oil sands have begun to worry about their public image as a result. The opponents of tar sands do not confine their objections to the production process. Many of them also oppose the building of pipelines needed to transport the oil to markets elsewhere in Canada and the US. Oil sands producers are particularly vulnerable in this respect, since there's already a shortage of pipeline capacity to transport the oil out of the areas where it's produced. This makes oil production vulnerable to pipeline outages, not only in the oil-producing areas but elsewhere, as we saw in late 2017 where a pipeline in South Dakota that used to carry Canadian crude to the US was shut because of an oil spill. As a result, several producers must now send their crude out by rail. Positively, there is sufficient rail capacity in terms of tanker wagons to move nearly 1 million barrels per day, but regrettably there's not sufficient track capacity to carry that much in addition to Canada's normal railway traffic. In January 2018, things came to a head. A combination of pipeline outages and increased production forced oil producers to seek tanker wagons on a short-term basis, only to find that the railway companies refused to take them on board, having given priority to agricultural traffic, which was being carried under long-term arrangements. This problem could well occur again this year when new oil sands production capacity comes on stream. Pipeline companies are trying to address the problem by both increasing capacity on existing pipelines and building new ones, but new pipelines run the risk of being held up by protests from groups objecting to them both in Canada and the US. It's an almost insurmountable problem. Since 2005, more than $200 billion has been invested in Alberta's oil sands. Money has poured in, fueling a multi-year boom in Alberta and growing the production from more than 500,000 barrels per day in the late 1990s to over 3 million barrels per day today. Yet investors have many concerns about the future of the oil sands because of the dramatic volatility in oil prices, considerable changes in North American oil industry and environmental policies. Whilst the bitumen fields are probably not going to be phased out by government, market forces mean the future could be good, bad or ugly over the next few decades. And the energy transition we're seeing across the world will have a significant impact on the future of oil production in Canada.